Good morning, ladies and gentlemen. Let me introduce myself. I am the student of Accounting Program, Faculty of Economic, Islamic Sultan Agung University, Semarang, Indonesia. As you can see on the screen, our topic today is income statement. The topic is very important for you because income statement will tell a story about the performance of your business over a certain time period, such as monthly, quarterly, or annually. I've divided my presentation into 6 main parts: definition, benefit, structure, types, example, and steps about income statement. In my presentation, I'll focus on 3 major issues. First of all, I'll be looking at what is an income statement. Second, structure of income statement. And third, steps to prepare income statement. I will begin explaining what is an income statement. Then I'll go on to why is an income statement useful. After that, I'll consider what goes into an income statement. Next, I will mention what are types of income statement. Finally, what goes into an income statement. My presentation will take about 20 minutes. Don't worry about taking notes, you can download my PPT on link in the description. And if you have any questions, feel free to interrupt me at any time. So, do we really need income statement? Is income statement important for business? Okay, income statement will show whether a company is making profit or loss for a given period. And from there, we can find out what things a business needs to do in order to be more profitable in the future. Let's begin by the definition of income statement. What is an income statement? The income statement is one of 3 financial statements that are important to business of all sizes. The other 2, the balance sheet and shareholder equity, go hand in hand with the income statement. The income statement is often referred to as the statement of income, statement of earnings, or statement of operations. But all of those terms mean the same thing: your profit and losses. Finishing subject, that's all I have to say about what income statement is. Well, I've taught you about the definition of income statement. Now, we'll move on to why income statement is useful. An income statement helps you to track the cost of sales, assess the sustainability of the business, prepare for tax time, plan and forecast. First, income statement will track the cost of sales. Income statement lets you track different types of sales and show the cost of those sales. That information can be used to gauge if your expenses are too high or your prices are too low. Second, income statement will assess the sustainability of the business. The income statement can help you to determine if your business will generate revenue over the long haul. It can also inform decisions about entering new markets, investing in expensive equipment, and taking out a business loan. Second, income statement will prepare for tax time. The income statement can help with the latter. Whether you're filing your income tax quarterly or annually, you're required to provide a lot of information about your business. With an income statement, the tax total is all there. And last, income statement will plan and forecast. The ability to plan and forecast is made much easier with income statements. Being able to analyze the trends in pricing and sales over an extended period can improve your ability to predict how your business will fare in the future. That's all I have to say about the function of income statement. Let me turn now to structure of income statement. What goes into an income statement? The income statement includes several pieces of key financial information that used to calculate profit and loss. They include the following items: operating revenue, non-operating revenue, gains expenditures, cost of goods sold, operating expenses, depreciation, owner's draw, earnings before taxes, gross profit, and net income. First, operating revenue. Operating revenue includes all of the money the business earns from providing a service or selling goods. Second, non-operating revenue. This is revenue earned through non-core business activities, such as rent from a property the business owns or royalties from a partnership. Third, gains. Often called other income, this is money the business made outside of its core operations. For instance, it could be money made from selling of land or an old vehicle. Fourth, expenditures. Expenditures are money spent on goods or services to run the business. They are recorded at the time of purchases. Expenditures differ from expenses, which are typically offset over a period. 5. Cost of goods sold, known as COGS. These are the costs associated with selling your products. They include the materials to develop your goods and the labor to get them in the market. 6. Operating expenses. These are the costs not linked to the goods or services you are providing. They can include rent, office supplies, and utilities, among other things. 7th, depreciation. These are expenses that are spread out over a long period of time. The value declines as the equipment or vehicle ages. Depreciation varies depending on the type of business you are operating. 8th, owner's draw. This is the money you take out the business to pay yourself a salary. 9th, earnings before taxes. This refers to your income before you pay and taxes on it. 10th, gross profit. Gross profit is calculated by subtracting the cost of goods sold from revenue. Gross profit is the profit the company makes. And last, net income. Net income is the income left over after you subtract all of your expenses from your gross profits. It's the most important line of the income statement. If your net income is positive, your business is doing okay. If your net income is negative, you may need to take a deeper look at operations. We've looked at the structure of income statement. Now we'll move on to what are the types of income statement. There are several types of income statements you can employ to stay on top of profit and losses, with varying degrees of complexity. For small business owners, the single-step income statement and the multi-step income statement are the most popular. First, single-step income statement. A single-step income statement is the easiest one to create because it uses one calculation to ascertain the profit or loss of the business. This type of income statement is simple to understand and easy to prepare, which is why it's commonly used by small business and sole proprietors that don't have several different sales lines. Companies that sell goods and services may opt to use the multi-step income statement. Second, multiple step income statement set by businesses set by businesses that sell tangible goods or have more than one line of business. The multi-step income statement, as its name implies, uses multiple steps instead of one. With this type of income statement, the operating revenue and operating expenses are separate from the non-operating revenue and non-operating costs, loss and gains. By separating operating income from non-operating income, a business owner can get a deeper understanding of his or her operations. The calculations to determine profit or loss with a multiple-step income statement include the following. Well, I've told you about the types of income statement. Next, this is an example income statement for a fictional company. As you can see at the top, the reporting period is for the year that ended on September 28, 2019. During the reporting period, the company made approximately $4.4 billion in total sales. It cost the business approximately $2.7 billion to achieve those sales. As a result, gross profit was about $1.6 billion. Next, $5,060.4 million in selling and operating expenses and $2,093.7 million in general and administrative expenses were subtracted. This left the company with an operating income of $7,065.2 million. To this, additional gains were added and losses subtracted, including $2,057.6 million in income tax. At the bottom of the income statement, it's clear the business realized a net income of $4,083.2 million during the reporting period. That's all the example of income statement. Now we'll move on to what are the best practice for income statement. First, setting up your income statement. Income statement measure revenues and expenses during a certain period of the time and are typically generated on a monthly, quarterly, or annual basis. Pick the duration that you want to use for calculating your income statement. Businesses that are publicly traded must generate income statement on quarterly and annual basis to file with the Securities and Exchange Commission. Business also generate income statement on a periodic basis to identify business trends and evaluate financial results. At the top of the document, write the name of the company. On the line directly beneath the company name, write income statement. On the next line, write the period of time that the income statement covers. Income statements have four distinct sections. The first section of the income statement calculates gross profit, or the total amount of money made from sales revenue and cost of goods sold. The second section calculates your total operational expenses. The third section calculates gains and losses unrelated to your operational costs. The fourth section calculates net income, or the money you've made in profit after subtracting your expenses from your revenue. Second, preparing the gross profit section. Sales revenue includes all revenue earned from the sale of goods and services. Regardless of whether or not the cash has been collected, list sales revenue for the period you selected. For example, say that you sold $10,000 units of inventory for $5 a piece. You will record sales revenue of $50,000 even if your customers have not all paid you yet. Cost of goods sold is comprised of the direct labor, direct materials, and manufacturing overhead expense you incurred to create the inventory that you sold. This cost of goods sold for the period underneath your sales revenue. For example, if you sold 10,000 units of inventory during the period and paid an average of $2 for each unit, you will record $20,000 for the cost of goods sold. If you are the seller, cost of goods sold is typically the price that you paid to purchase the inventory. Your gross profit is the total amount of money you made during the period before your expenses. Write the difference between your sales revenue and the cost of goods sold on the next line on your spreadsheet. For example, if sales revenue is $50,000 and the cost of goods sold is $20,000, you will record gross profit of $30,000 on the income statement. Use a green pen or change the font color to show that the number listed is a profit. Third, totaling your operational expenses. Operating expenses are expenses that directly relate to business administration. Next to each line item, list the amount of expense incurred during the period. Common operating expenses include salary and wages for those employees not directly involved in the product of goods, rent, insurance, office supplies, professional fees, utilities, transportation expenses, marketing, depreciation, and property taxes. Direct labor has already been deducted from the cost of sold goods. If the business has a large variety of expenses, you can group similar line items into one category to save space. For example, you can create an employee compensation line item that includes salaries, health insurance premiums, retirement benefits, payroll taxes, workers' compensation, and payroll processing fees. Add together the expenses to find how much money you've spent. Take all of the items in your expenses list and add them together with a calculator. Write your total expenses on the next line of your spreadsheet. Use a red pen or change the font color to red to signify that the expenses should be subtracted at the end. Depreciation and amortization are both methods that reduce the recorded cost of assets. Depreciation is most commonly calculated using a straight line method, which is gradually reducing the cost of tangible asset over its useful life. Amortization is used for intangible assets and is calculated similarly to depreciation. Fourth, calculating gains and losses. Non-operational gains are revenues that don't directly relate to business operations, sales, and production. These revenues are from activities that are different or peripheral to normal operations, such as investment or unrelated sales. Next to each line item, list the amount of revenue incurred during the period. Common non-operational gains include interest revenues and gains from the sale of securities. These items add to the income of the enterprise while expenses reduce income. Once you list all the non-operational gains your business has, add them together so you have one number for total gains. Put the total gains on the line directly underneath your list so you can easily find it later. Write your gains in green so you know that they are profit. Non-operational losses also don't directly relate to the business operation or sales. Next to each line item, list the amount of expense incurred during the period. Common non-operational losses include interest expenses paid to the lenders, losses from the sale of investments, and losses from litigation. Add together everything listed in your losses section of your income statement to get your total losses. Write the total on the next line of your statement so you can easily find it later. List the total losses in red to color code your spreadsheet. That way you know to combine them with your other operational expenses. And last, finding the net income. Find the gross profit you calculated in the first section and against the third section of your statement, and add the number together to find the total profit your business gained over the period of time. Look at the total operating expenses from the second section and your non-operational losses from the third section of the income statement. Add the two numbers together to find the total amount of expenses your business had. Take the expenses you just calculate and subtract them from the profits. Write down the net income at the bottom of your statement. Your net income could be positive or negative depending on how much you spend and earned during the period of time. That's all I have to say about the step of income statement. In conclusion, income statement indicates profits and or losses that the company earned at the end of the period. If the net income is positive, then the company is profitable. Otherwise, if the net income is negative, then the company is losses. This is the references I use for my presentation. May I thank you all for being such an attentive audience. If there are any questions, feel free to ask me on comment below. Wassalamualaikum warahmatullahi wabarakatuh.